We have with us Manish Gunwani, Senior Fund Manager at ICICI Prudential, who is joining us as our market master for the day. Good morning, Manish. Thanks much for joining us. First, give us your spin on this China rate cut issue. There was one person who interpreted it earlier in the morning, Manishi from BNP Paribas, that it would make materials expensive, commodities expensive. So for a commodity importer, it need not necessarily be good. As well, if it makes China attractive, is there incremental money likely to go to China than India? So for the moment, will it end our outperformance or at least trim our outperformance?
Well, Lada, as someone said, China seems to be undergoing these mini cycles of CPI, crisis, policy, investment.
Okay.
So they hit a crisis, they do some policy reforms, and then infrastructure picks up, but again, they hit a crisis. And I think the secular trend seems to be pretty clear that the super cycle in commodities is over. So either you can take that long-term view, or obviously based on stock valuations of metals and oil and gas, some of them, you can trade this China mini cycle. But yeah, I think the secular trend, I think, is pretty clear. So yeah, in the short term, you could see a lot of EM money going to China because obviously, I guess it will be very under-owned, it will be cheap. But really, I think the long-term effect on India should not be very substantial, is my guess.
Okay, that's interesting because that's what someone else was pointing out earlier as well. The reason for the rate cut is because there's no growth in China versus India, which is an emerging growth story. So do you get a sense that this outperformance that India has been seeing will continue? And if yes, what are the pockets of value now in the market?
So we still think over 3 years, both for EM allocators and for Indian households, Indian equities will probably be the best asset class to own. Because we should not forget that the hand of God has been very kind in terms of crude price. So that's such a big tailwind for the Indian macro that it kind of helps us outperform, I would think, quite reasonably. So in terms of pockets of value, again, you have two kinds of pockets. One is the secular pockets and one is your more cyclical pockets. So if you see banks, for example, you could still be in private banks. Some of them are still cheap relative to historical valuations, and obviously they are secular plays. So you could hold them for long periods of time. But again, PSU banks also look interesting because very few kind of companies have as much operating and financial leverage to an improving macro as much as PSU banks have. So that pocket also looks interesting. So I think across the market you will have secular and cyclical companies, and I guess you probably have to kind of bottom up choose where you want to be.
Actually, you're almost inviting me to ask this question by speaking about private banks and public sector banks. With this now global move towards slightly more easy policy from the ECB and more importantly China, how are you gauging the December 2nd action from the Reserve Bank, as well future action and stock impact because of that?
So Lala, I think interest rates are a function of market and RBI put together. It's difficult to guess what RBI will obviously do in the short term, but I think the market is already showing you the way to lower interest rates. So if you see your 10-year yield, if you see short-term rates, they are trending downwards, and you are also seeing some banks cut fixed deposit rates. So I don't think we should be too fussed about whether the rate cut happens in December or Feb or March. But I think from a 2-year perspective, I think it is quite safe to say that we are in a lower trending rate environment, and that I think is obviously very good for financial asset classes, long-term duration bonds and equities.
Yeah, actually, Nomura was making a point last week here that they see actually a 200 basis point cut in fall in the 10-year yield, for instance. What is your expectation? And I think that was over a 12-month period, if I'm not mistaken, 12 to 18 months.
Again,
what's your expectation, and therefore is fixed income that attractive, or will equities do even better?
It's difficult to choose between the two. All I can say is we're very positive on long-term duration bonds because we do expect inflation to trend down faster than people think.
6 quarters, 6 half? That was what they were talking about.
I don't want to put a number, but as I mentioned, I think in the last visit, that if you look at Indian inflation, there are a lot of cyclical components out there which we think the base effects will wear off. So whether it is currency depreciation from 48 to 60, commodity price which was very high, or even the fact that a lot of subsidies have been passed on to the corporates and Indian public over the last 18 to 24 months. Diesel is what makes the headlines, but if you see even electricity tariffs, railway freight, so these are very good things over the long term, but obviously they have impacted inflation numbers in the short term. But I think going ahead, you're obviously not seeing the need to do this again. So there is a very high base effect in Indian inflation if you see on a 1 or 2 year basis, which we think will play out. Plus the fact that there is a lot of spare capacity. If you look across cement, autos, etc., there is so much spare capacity in the system. And even if we get some growth, I don't think there will be great pricing power.
Okay. You did mention a while back that some private sector banks still look good as far as valuations are concerned. But which are these banks? I mean, if you take case in point Axis Bank, it's trading at more than 2 times price to book, which is much above its 5-year historic average. So are you looking at private sector banks outside the nifty stocks, or do you think even some of the larger banks are worth looking at now?
I think there is some value still left across the market cap chain. So again, on a historic price to book, probably they're not cheap, but if you look at assumptions on loan growth and asset quality over next 2-3 years, I think there is a chance that all of us can be surprised on the upside, because typically I've seen that it's difficult to model on the upside how much improvement can happen in bank balance sheets. So I do think that across the value cap chain, there is some value still left in private banks.
Okay. We do have the winter session of the Parliament that's starting today, and all eyes will be on the land acquisition bill, insurance bill, etc. What would your expectation be from the session this time around?
So definitely, I think government-led reform is one of the key pillars of this market. So to that extent, I think the market would be looking for progress on things like insurance, etc. And I do think it should happen, hopefully.
Okay. Well, what in the mid-cap space is your area of choice? I mean, would you like, for instance, auto ancillaries, tire stocks? Tire stocks have been doing well. Actually, maybe we can get that money control question up for you. There is one of our viewers saying, what is the long-term outlook for MRF? Your choice whether you want to answer this question. But this is coming to us from Lithin, who writes to us wanting to know. But basically, tire stocks, basically auto ancillaries, or is it logistics? What is your area of preference?
Now, again, I don't want to go into single stock specifics, but very broad sense, I think the consumer discretionary and auto ancillary space, I think it's slowly reaching fair value.
Okay.
So the kind of deep value we found in that space, let's say 6 months back, is not there right now. Okay. Relatively, I would think pockets of deep cyclicals, something like logistics, as you mentioned, some capital good companies in the mid-cap space. Today, I think those stocks seem to offer more value than consumer discretionary led space like auto and auto ancillaries.
All right, Manish, thanks for joining us and talking about all those pockets, and we will take that view forward of yours that this is for a multi-year bull run that we're sitting at, and India will be, or rather Indian equities will be the best asset class for the next 3 years at least. That's the word coming in from ICICI Pru.